Hello, everybody. This is Dr. Richard Smith here, continuing our 80th anniversary celebration for the Foundation for the Study of Cycles. It's been an incredible week already. The Science Summit that we had on Saturday was incredible, and then Bob Prechter and Tom DeMark. And today I have another incredible guest from us. We're delivering the real deal here. That was our main criteria for the Financial Cycle Summit. We want the real deal. And today I have a very special guest who has literally won over 30 trading championships around the world. His name is Rob Hoffman, and I'm excited to introduce you to him. Rob is the founder of wealthcharts.com and also of Wealth365.com, which is the biggest online financial conference in the world. Rob, we are thrilled to have you. Welcome.
Well, thank you, Richard. It is great to be here with you and everybody. This is a very special event, the 80th edition, 80th anniversary. So I'm really honored to be here with all of you today. And so Richard's going to look for your questions so that we can try to keep this moving for you and hopefully share a lot of really neat things with you along the way. So my goal today is to actually share with you. I'm going to take my screen over here.
I'm going to turn off my video, so you have the floor, Rob. Take it
Wonderful.
away.
So so my name is Rob Hoffman, and like I said, I have becomeabettertrader.com, which is an educational home for you. Wealth365 is the largest trading investing show in the world, and then Wealth Charts is a wonderful platform where we can focus on all sorts of technical analysis, studies, and everything else. And so I'm glad to be here with you. And so what we're going to do, just a reminder, I have nothing to sell. This is pure education today. In fact, at the end of this, I'll just give you access to a strategy guide that will that you'll be able to take away from this as well, and some other tools that may be of benefit for you for active traders and investors out there. So before we get going, just a reminder: trading involves risk, not just reward. Always consult a registered financial representative and a risk trading plan before ever trading or investing in anything. And of course, that involves real estate, precious metals, just anything that's an investment. Look to the experts for additional information. And if you guys ask me about some hypotheticals, how I might handle something off into the future, if it's not here in the right here on the screen in front of us where I can trade it live, then it's more theoretical, and there might be fast market conditions or some sort of other risks associated with hypotheticals. So I'll try to be as accurate in my information as I can about how I'd handle something off into the future, but just always keep that in mind. Those inherent risks there. Also, for those of you that trade options, there's a great disclosure document you can look at to understand the different types of options trades, because some of the strategies I use and will share with you are, in my opinion, excellent for options traders as well. And so understand the different types of trading options trades out there and the risks associated. There's a little document you guys can go to. So with that being said, if you trade stocks, options, futures, and of course with stocks, it's stocks, ETFs, options, futures, Forex, then this is really a focus for you. This is not just for day traders, it's also for swing traders. You can use it positionally for longer term cycles as well. But everything I show you today on an intraday, daily, or weekly basis would be more used instead on weekly and monthly charts. Okay. So I just want to kind of set that groundwork for you there as well.
And Rob, I want to set the table just briefly here too about what we talked about. I asked you to really share the techniques that you have used to win 30 plus live trading championships. And so it's not necessarily going to be focused, on cycles right out of the gate, but I think that these strategies are applicable to lots of different approaches to the markets and can complement cycles work and other strategies. Is that kind of how you see it too?
Yeah, no, that's very accurate. And in fact, when you have a cycle, right? So there's the evolution of the peak and the trough and
Right.
that of the cycle. Well, so once you're coming out of those peaks and troughs and you're breaking out into a new move and a new trend, well, then you need to have your initial entry ideas, your
Yep.
continuation patterns, and then of course, depending on the nature of the cycle you're talking about. I mean, there's cycles for a 5 or a 10 minute or 15-minute trader. There's cycles for daily, weekly traders.
Yep.
And so there's different ranges and magnitudes of cycles. I believe, Robert Prechter went ahead and discussed some much longer term cycles,
Yep.
but there's also these more shorter term cycles. So absolutely. So everything I'm going to say today absolutely 100% applies to entry and re-entry opportunities within those cycles once they've gone ahead and presented
And
themselves.
of course,
So
our mutual friend and FSC board member, Jake Bernstein, who ironically is speaking at Wealth365 this evening while we have you here, I believe, right?
that's right. So as it turned out, Jake said, "Rob, Richard's put out this wonderful show. Would you like to speak for him?" And it's like, "Well, sure. I'd be honored to go ahead and speak for such a reputable organization." And but it was supposed. I was told it was the week of the 11th through the 15th,
That was a
and.
trick.
And it was a trick,
It was
and
a
then it
trick.
turns out it's the 18th through the 20th, the 22nd, and this week the 18th through the 23rd at Wealth 365 we have this large financial conference. And so yes,
Right.
literally Jake Bernstein, I will not be able to introduce him because he is starting in about 24 minutes on my show, but I will
Yes.
be able to outro him.
All
So,
right.
but that's
Well, take
great.
it away. I'm going to get out of your way. Appreciate it.
No worries. So as we go ahead and kick off here, then my background, just briefly. I've written a lot of articles about the strategies I'm going to share with you tonight. Back in the 90s, we were talking about these types of strategies. I wrote about them in the 2000s here. And this is kind of, what I do. I do these real money live trading competitions around the world. A lot of people talk about trading and investing, but I actually go out there and do it with real money at these trading competitions. So I've been featured in domestic and international magazines, a lot of time talking about either the psychology around trading or the actual strategies of trading. This is the system that I'm going ahead and broadcasting to you from right now. And but whether it's different types of magazines there, the things I'm sharing with you today are the tools I've used in those trading competitions or written about in professional magazines. Okay, I actually recently spoke about some of these things at for the London Stock Exchange and Borsa Italiana as well. So just so you understand, the level of education is not just theoretical, it's practical. Okay. And this is really, this is what happens with these trading competitions. Some of the bigger ones are very highly regulated. They got judges standing all over you like they were with me here, big audiences of people asking questions about what you do. And a lot of these are like elimination events where you start out with like 16 traders representing their countries around the world. Then it goes down to 8, then down to 4, then down to 2 over the course of like a 12-hour event or whatnot. So, kind of exciting. And actually, my very last trading competition I did here, we went ahead and went up against an algorithmic machine. So this was the performance of the algorithm, which was quite impressive. But I was fortunate enough to go and beat the algorithm by just shy of 2 to 1. So human interventions still can rule. It's kind of like it's great to go ahead and have a computer fly in the airplane, but you're still kind of like a pilot there just in case, right?
We're
And
not
so
obsolete yet.
that's right. We're not quite obsolete yet. Although at Wealth Charts, admittedly, I've been working to make us as obsolete as possible by automating, turning a lot of things into algorithms.
Right? We want to
But
be optimally obsolete.
optimally obsolete. Well said. Exactly. And so this is all the trading competitions I've won around the world with real money over the last, since 2011. And obviously in 2020 here, I wasn't able to travel anywhere. So I didn't get to go to any of the big European trading competitions like I did the last, several years. And I did US ones early on. So with that being said, so in summary, I really trade. And that's, I guess, the key thing here. Now, that being said, the reason why I trade is because of these two little ones here. This is my little 4-year-old boy and my little 6-year-old daughter and my lovely wife. And, that's what inspires me to trade and do what I do in life. And we all have our reasons. And I'm sure each and every one of you here today is inspired to be an active trader and investor and to focus on cycles and your favorite tools and analysis for your reasons too. These are mine. So with that being said, what I hope to try to do for you here today is kind of cut to the chase of a couple of those different tools, and I have many. Richard said I don't have to stay to an hour, but I can't stay here all night. So that means I'm going to have to pick and choose some things to share with you. Otherwise, I'd stay with you all night. So what we'll do here is think about where I was back in the 90s, and I was actually teaching like the AAII, American Association of Individual Investors Special Interest Groups, AAIC groups back then, and and trying to think, what would I have liked to have known then that I know now. And that's what I'm going to try to share with some of those things with you tonight. So most of the strategies that I have try to have you focus more like an institutional trader. I teach retail and as well as RIAs, registered investment advisors, and institutionals alike. And these are the kind of things that I'm focusing on. So we've got buy side mistakes and sell side mistakes, and I think that this is being recorded for you. In fact, Richard, can you just confirm for me that this is being recorded? Will they be able to see this later?
Yes, it's automatically available on YouTube right after we're done.
Okay, wonderful. So, gang, so I won't spend too much time on this. I'll let you look at this. Normally, I could spend an hour just on this right here because there's a lot of great tools. I'll try to interject some of the learning from these different bullet points as we go along. But right now, let's start off with one of the core concepts that I use. I have many different strategies. I want to go ahead and focus on the Hoffman inventory retracement bar and the reverse inventory retracement bar to start off today. And the reason being is, as we're talking about cycles as well, because as we think about the cycles, right? Well, the thing is, what do we need to do? We need to have those ideas that either enter or re-enter moves through this whole process right here. Okay. And that's what I want to go ahead and do. Also, and it's funny, I was just showing this to Richard a little bit earlier. I want to know where maybe it's time to back off of this. So I'm going to go ahead and if I don't remember, Richard will hopefully remind me. I will show you some real world examples of that as well from a cyclical perspective. So, armed with all that, let's talk about inventory retracement bars. And really, you could call this an institutional retracement bar if it helps you remember it, Hoffman IRB, because what it is, it's institutional inventory. And so what it is, it's a price action based continuation trade. When do I use it? Typically, I prefer to use this in trending markets, and it can be amplified by strong fundamental analysis for investors. It's great to have a fundamental story, but until Wall Street discovers it, it's usually not best to go ahead and actually enter those particular trades. If you can take a great fundamental story and then wait till you get a technical buy signal, then you got that kind of techno-fundamentalist story going on, and then it's a higher probability trade from my perspective. So that's what we're basically saying there. So how do we identify this? And of course, I'm going to show you examples, on the charts or on the pre-made PowerPoints, and then we'll go to the live charts. So don't worry about getting yourself too caught up in the definition right now. But in general, how do we identify this? Looking back over the previous 20 periods. Well, why in the world does it say 20 periods? What does that mean? Well, it's what it means to you. For instance, those of you that are trading intermediate cycles, that might be 20 weeks worth of data. Theoretically, if for longer term cycles, it could be 20 months of data. For those of you that actively trade and invest on an intraday basis, or over the course of typical swing trading like options, a few days to 6 weeks, then those could just be 20 days or 24-hour bars, etc. So 20 periods, whatever time frame you execute trades on. This is a very fractal strategy, so it's important that you understand that. Okay, so over the last 20 periods where the open and the close are approximately 45% or more off their high in an uptrend, or 45% or more off their low in a downtrend. So think about the rule of 45. Okay. Now, as we're looking at these examples, because I've automated this process, of course, in my charts, but not everybody else has. And so you can just kind of eyeball it and ask yourself, is the bar approximately 50% off the high or 50% off the low? 45 is what I've kind of found to be optimal, but again, you please feel free to use that 50% as, if that's easier to see. So what we're looking for in a downtrend here, I'm looking for these bars. So you take the low of the bar to the high of the bar, and then what I'm really looking for is that bottom part, the bottom 45% or more of the bar being wick. So you can see here, the bottom of these, that's about 50% wick. This is about 50% wick. This is about 50% wick. Now this one's like 90, 95% wick. Okay. So there's a couple things I want to talk to you about here. Number one, this is not a 4-bar pattern. These are just 4 individual examples. The reason why I wanted you to see this was, it's just important to understand, it's 4 individual unique pattern. Sometimes people think that this is a 4-bar pattern they're supposed to look for. And what's important here is that it doesn't matter whether the body of the candle is green, a small red, a medium red, again, or a green. What matters is it 45% or more off the low? Okay, that's what's important there. Now, the next thing is to understand this part right over here. When you have a bar that's like 90, 95% off the lows, that's probably too far and usually best being avoided. Here's why. Because remember now, we're in a trend. So a cycle in the past here was going up, and now it's sitting here rolling over, and we're starting to go down. So what I'm looking to do is get 1 tick, 1 cent, 1 pip, depending on the instrument that we're trading, below the low here. Now, if I'm trading an option, then what I'm looking to do is I'm still looking at this from the underlying perspective. Okay. So I'm not focusing on trading the Greeks. This isn't even really about the implied volatility or anything else. What we're focusing on is the underlying fulfilling, this pattern here. Okay. And so what I'm looking to do is then once this next bar opens up, I'm looking for it to break down. Now, it may be 3 or 4 or 5 bars before it breaks down, but I'm looking for it to break down and then start to accelerate to the downside. Same thing over here. I'm looking for us to break down 1 tick, 1 cent, 1 pip below the low here, and then enter the trade from there. Now, a quick stop loss tool that can be used for this is right on the opposite side. So if the entry is here to the short side, the stop loss can be right back above the high, because as you'll see, what should happen once we get back into the direction of the trend is it should start to accelerate to the downside. It should start to lollygag around here and then start to turn around and go back up. Okay. Now, the other thing to keep in mind here, though, is this: if this bar in a situation like this is if the bar you're looking to trade is roughly 3 times or more the size of the preceding bars. So let's say the preceding bars were like this length here, whether they're a daily, weekly, monthly bar, 2-minute, 5-minute bar, it's all fractal, whatever time frame you trade on. And then all of a sudden this one's like, 3 times or more the time or the distance. It's probably better just to step away from that and avoid it. Okay. There's a host of reasons for that, because that could become more of a short-term bottoming pattern. The other thing is, when you have a situation like this, remember our entry is way down here. If you recall, that means now in this case, it's got to use up all this rocket fuel, all this energy just to get back down there. Okay. Not to mention the other part of that is your stop loss then is all the way back up here. Now, can you imagine? That may not be that big of a deal on a 1-minute chart, let's say on an intraday basis, but could you imagine if that was a weekly bar of Tesla? That could be a $50 or $100 bar. And so you may not want to take that kind of risk. Okay, so just keep that in mind. A couple of little things there. So in a downtrend, we're looking for bars to basically come back off their lows, which breaks the spirit of anybody looking to execute a short. And they're like, whoa, good thing I didn't take that trade. That would have been another one of those losers. Only to have it turn around a few minutes, few hours, few days later, to based on the time frame you trade, break down lower, and then it goes without you, and then you get frustrated. So that's what one of the things we're looking for. In an uptrend, it's just the opposite. I'm looking now for the bars that are 45% or more off their high. Okay. And these are all slightly more than 45% off their high. It's more like 50%. So it's easy for you to kind of eyeball it. So with that being said, the now what I'm looking for is just the opposite. I'm looking, remember, we're in an uptrend. Okay. Now, one or more institutions has temporarily halted the market and driven it back down. Now, think about what that does to you psychologically. And I won't be able to see the people's answers here, unfortunately, today, but I know the answers. So I just want you to think about how many of you in the past have thought about getting into a trade. You saw the market starting to go ahead and turn around, coming out of a cycle and starting to push back up here. And you're like, I think this is going back up now. Look, this is starting to have these big green bars. And then all of a sudden you're right about to get into the trade. And all of a sudden you get this bar that pulls back. It comes way back. And so like, whoa, good thing I didn't get in that trade yet. Oh gosh, that's probably going to roll back over. That would have been another one of those losers. Only to go ahead and skip the trade because you had your spirit broken by seeing it come back like it did. So you step away from it and elect not to do it and take the trade or the swing trade or the position, and then you come back a few minutes, days, weeks, months later, depending on your time frame you trade, and seeing it much higher highs, and you're like, I knew it was going to do that, and then you get very frustrated. So what this pattern is identifying, it's getting you to think about being the hunter, not the hunted. And when you start to see these pullbacks within the new uptrend in this case, you're starting to say, I'm going to start keeping my eye open now and see if we start breaking back above the high of these bars. Okay, that's what it's.
I did. Rob, I'm interested. This is fascinating. And you're a great teacher. Wow. Obviously, you've been doing this a long time. You're calling it distribution in an uptrend, right? But yet
That's
you're
correct.
also saying that it signals, a higher move up. And usually you think, hey, in an uptrend, distribution's a bad thing. That means price is going to go down eventually. So why is distribution in an uptrend a bullish signal here?
Great question. And the reason is that what you're talking about here, see, first of all, we have to dispel that myth, that rumor that all of these, well-to-do financial magnates are all getting together on the greens on the weekend, saying, "Hey, I think I'm going to buy up Tesla. What do you think? What is your firm going to do? Are you going to buy it up, or are you going to sell it?" Everybody thinks they're all in cahoots with each other, and the cold hard reality is that they're all out. It's a cutthroat business. They all want your 401k and investment dollars. They're not telling each other what they're doing. It's like super secret, and everybody's got their proprietary methods to buy or sell the market. And so what happens is within a trend, let's say there's 3 or 4 big firms that might be active at any given time. Well, the thing is, maybe 3 of them are buying them up, but one of them bought way down here and is now starting to go ahead and sell into this market a little bit. They bought down here, so they're saying, hey, I need to lighten the load. Well, when they start to lighten the load, that puts, you've got hundreds of millions of dollars or more under management there. That can put short-term pressure on that market. But that doesn't mean in this case, like the other 3 institutions aren't continuing to buy. So remember, we're trend trading. We're trading with the cycle that's emerged. And so you just have one institution for whatever reason. There could be lots of reasons positions are being taken. For instance, buying fresh inventory. What about a company, a big investment firm is trying to garner the investment business for a secondary offering? So like, well, hey, we're going to support your stock. We're going to support your float. So if it starts going down, we're going to start buying it up. Well, in that downtrend, that could go ahead and cause short-term lift in the price. even though everybody else is saying, hey, I want to sell this, but they're trying to earn some secondary offering business is one of many examples. Does that make sense?
It's like a partial. Somebody's accumulating or distributing, but not the whole market.
That's right. That's right. Exactly.
Yeah.
Yep.
Very helpful.
So
Thank you.
You bet. So with that being said, just take a look at lots of, different examples. So this is one I just like to show a lot, even though it's an old example, just because I even show retail institutional clients alike. And this also deals with short-term cycles as well, that I like to use stochastics in that as well as part of this. And so what you have here, this is a weekly chart over here. And here you can see this bar that's 45% or more off the low. Now, interesting to note, look what happened. The next few weeks, the market actually went up, and then it sat here for a few weeks. It sat here for 2 weeks, and then when it broke down, it whooshed down about $30 in a week. Now, this brings to mind a whole bunch of different things. Number one, it brings to mind why you should trail your trades. And if we have enough time, I'll go through the trailing process. I have some slides on that because like psychological round number levels are always a good place to start tightening up your trades at. But it also goes ahead and highlights that process, how where you get a key support level in the short term, the market can find support. So there was institutional support in here, and then when that buying dried up, the market was quickly able to evaporate and go back to the downside. Now, at the exact same time this is happening over here on this weekly chart, you'll see a bunch of distribution. In fact, let me highlight it in here for you. You can see right there is an accumulation bar, accumulation here, here, and here. But look what happened when we broke through each of those levels. It started to accelerate to the downside, and then started to accelerate to the downside, then started to accelerate to the downside. Meanwhile, that whole same process was happening on the daily chart at the exact same time. So it's very fractal, and seeing the selling on a shorter term time frame as well as the larger time frame. But you'll see what happened when you had that accumulation bar. It sat there for about 3 days as the price was still being accumulated by one or more institutions, and then when they dried up, the market whooshed to the downside. Then in fact made fresh reentries and fresh reentries. Okay,
so the left side is weekly and the right side is daily. Is that
that's correct?
Here? Okay, great.
That's exactly right. Yep.
And I'm starting to see now how, like with cycles, going back to your fundamental story supported by a technical indicator, like it's essentially the same thing with cycles. You see a cycle turn, but you don't. Sometimes turns can be sloppy. Take a little time, be sloppy, right? So wait for a signal like this on the time frame that confirms the cycle trend change.
Exactly. That's exactly right.
Got it.
Okay. And so then as we continue on then with this, so where's the entry? It's typically 1 tick, 1 cent, 1 pip, be above or below the signal bar. Typically look to trail up to the next key support or resistance level. That could be like Fibonacci numbers, Fibonacci extensions, key long-term support or resistance levels, previous cycle highs or lows. Your favored, the preferred target. And then if we have time, I'll show you how we look to trail that there. So where's the stop loss? Typically and most efficiently, it's 1 tick, 1 cent, 1 pip beyond the opposite side of the signal bar you entered on. It's because, remember, statistically what we're expecting, what our plan is, what we're looking for is for this market to, once it breaks through that accumulation or distribution bar, expect it to start whooshing basically into the direction of the pre-existing trend. And so it had a short-term pause, and now we're expecting the market to push heavily back into the direction of the original trend. And so what that does is, think about how many times in the past maybe you went ahead and bought a stock up here, and then all of a sudden it started to go down against you. Now, in that process, it started to go ahead and actually push back up. And you're like, yeah, go back up, go back up. You start cheerleading it, hoping that it's going to go back up, only to have it go up a little bit, roll back down, and then really start to accelerate to the downside. Well, a lot of times where you see that happening is right where those inventory retracement bars that I was telling you about exist.
Hey, Rob, so I don't know if you know this, but when I first started trading, I used to actually move markets by the click of my mouse. As soon as I clicked buy, the market would turn. And I knew that if I waited and as soon as I clicked buy, I could turn the market on a dime. It was incredible.
So with that being said, so this is why we're trying. There's specific types of behaviors we're looking for at these key support and resistance levels, and that's what I'm trying to share with you here. So those stop losses, we expect that what should happen is once you have one of those accumulation or distribution bars, that we then should start to see a progression, continuation into the direction that you took the trade very quickly. And if you don't, then something's wrong. Okay. So as far as the trailing stop methodology here, typically, like I said, what I like to do is I'll find whether it's a pivot point, daily, weekly, monthly pivot point. It could be a Fibonacci extension. It could be a previous cycle high or low, major previous high or low in the past. Whatever it is, what I like to do is find that high, identify that as my target into space, and then initially I like to trail by about 50% of the profit earned. So what happens is when I'm about 50% of the way to that target, start trailing about 50% of the way up. Then as we get about 80% of the way to the target, like to trail about 80% of the way up. Then as we get right up by the target, like to go ahead and actually trail right up about 90%. Why? Because what's more likely to statistically happen? After this thing has been using up a lot of rocket fuel, using up a lot of energy, going boom, 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 when it gets up to that resistance, is it more likely just to keep going, keep going, keep going, or is it more likely to stop and reverse? Typically, it's far more likely to stop and reverse. Either right about it, or it'll pop up just a little bit through it, then come back down, or it'll fall just short and roll back over. And so I want to trail the trade up because it's a crime to me to go ahead and have so much profit on the board only to go ahead and watch it come all the way back down here and then actually turn into a loss. And unfortunately, way too many people do that, and then that gets you in trouble because then it causes you to do really bad things the next time around. Okay, so that's and for the few times where it'll just explode through the key support resistance level, then it's just basically an active trail, active trail, active trail until it stops and takes it out. But typically it's at 50, 80, 90 price is kind of the trailing stop methodology. So those are the rules for the inventory retracement bar. Now, what I want to do then is a couple things to remember. Don't forget about rocket fuel. If it's moved too far, too quickly, then it's more likely to fail. Remember those big wide range bars I was telling you about a few minutes ago? Mm-hmm. It has very diverse applications, stocks, options, ETFs, futures, Forex. So it has very diverse applications there. Trail your entries to reduce risk of reversion to the mean and basically giving up all the profit opportunity, and then trade the direction of something simple like a 19 to 21 period moving average. Whatever your favorite trending tools are, chances are if you're watching this video today, and you are part of the foundation of studies of cycles, then you're probably more sophisticated, so you have your own advanced trending tools. But if not, then 19 to 21 period simple or exponential moving average is great. I personally like 20 period exponential, but I'm sure you'll find your own that you prefer. Now, let's go ahead and talk about this, one more time. In the uptrend, we're looking for those bars that are 45% or more off their high. And I wanted to kind of show this here because these were early days of Tesla. Back, what would happen, I saw it happen like clockwork. The market would come up, the market would start to pull back a little bit, and then everybody in those chat rooms would all sit there and say, oh, that's it, ding dong, the witch is dead, Tesla is over, it's all over with for Tesla, and it's going to roll back and die now. And then it would break those highs, and off to the races it would go. It'd break those highs, off to the races it would go, over and over and over again. Okay. So if you go back and do some studying on that, I think you'll find that very interesting. Here's an actual trade I took during a trading competition over in Europe. This was gold in the middle of the night there. And so what happened, because obviously the trading competition in Europe starts in the middle of the night our time. It's like 2 o'clock, 3 o'clock in the morning. And So here was the bar. It was about 45% or more off the low. I went short. This was an actual trade that I took, gang. Just to help you understand there. And look what did. It broke down below that low there. I went short, and then within a few bars, it whooshed to the downside. In fact, it had another accumulation bar right there. So you see that it had the accumulation bar, then it had another accumulation IRB, and then it really just kind of let loose there. And that was helped me, one of those that helped me win that round of that trading competition to move on. Here was another example. Now, this is interesting. If you recall, the judges were standing over me before. And what's really interesting about that is because you got to show them all your trades. So first you got to come, you got to bring your brokerage statement. Your broker's got to sign off that you do, in fact, have the exact amount of money live in your live account and that it's real money. And then they have the judges stand over you and verify that you're taking the trade out of the account that you had the live money designated for. Okay, so that way there can't be any funny business. Well, so what's nice about this trade was I was actually able to then, so the market was in a downtrend here, and there was one of those bars that I was telling you about. And so what I was able to do was go ahead and go to these were like 2-minute bars. I was able to go to the judges in advance, say, hey, I've got an order out there. So I had an order to short here, and I was able to go ahead and put that order out. And basically 18 or so minutes later, it broke down through there. And what did it do? Whooshed to the downside. So I took the profits on the initial trade there, and then I got back short again, and then it whooshed down again. So what was nice was I was able to tell the judges well in advance, even in an intraday competition, where I was positioned, so they could validate the order in advance. So then it was much more easy for them to verify it on the back end, write it up on the screen, all that stuff that they have to do during those really highly regulated competitions. So here's another trade that I did. This was crude oil. And some of these competitions, they would have you trade crude futures. Some they would have you trade stocks. Some trade forex. Some actually, in the more recent ones I did, actually were triathlons. Basically, they were stocks, stocks, futures, and forex. So you had to, like, one round was designated for each of those. So kind of interesting. But here was another trade, same concept. The market was coming down. Here's that bar, 45% or more off the low. I went short, and then the market whooshed to the downside. Okay, so so now you can kind of come back, see with hindsight, looking back at that, like Apple Daily and Apple Weekly, now you can start to see that a little bit closer. Now, what I want to do is show hopefully just one more example right now. This was Apple after it split, and it went ahead and here's your bar. It's 45% or more off the low. Now, notice that it's actually much lower than that, but notice the size of this bar is really, this is a daily chart. Notice the bar size is effectively the same as the bar before. So that wasn't that overexhausted bar that I was warning you about, right? This is basically this bar and the last bar before are basically the same size. Okay, so it went ahead and it broke through that 45% or more off the high in the uptrend. Went up 45% or more off the high in the uptrend, 45% or more off the high in the uptrend, 45% or more off the high in the uptrend. Okay, now, so that's what we're kind of looking for. As we go ahead and take a look at I had some cycle related stuff. I'll see if I can interject that in a little bit. I want to kind of keep the training going on. This is another example where I just got done teaching a class on this IRB strategy. You guys can see it right there. Well, what's nice is you can time this even with short-term cycles. So like I use oscillators as well, like stochastics. So what happened here was I just got done teaching the class, and then all of a sudden there was that bar that was 45% or more off the low in the downtrend. You guys see it? And so what I did was I went short right below the low, and what did it do right afterwards? It whooshed to the downside. And so it's nice. Go ahead.
So just the trend that you're following is a 20-period EMA of your preferred time frame, whatever it is, daily, weekly, 60-minute, whatever time frame you're working in.
Yeah,
Is that right?
that's a very oversimplified. I'm trying to give somebody a free tool that
Yep.
everybody can walk away
Yeah.
with today here, Richard.
Okay. Yep.
Obviously, I use a lot of additional
Yep.
wonderful
Perfect.
tools
And
to
then
add
how
to
do
that.
you
But yeah,
use the fractal aspect? So if you're trading a daily chart of Apple, are you looking at what are you doing with the weekly chart, for example, or the 240 or the 60-minute chart?
so multi-time frame analysis is extraordinarily important to me. In fact, like inside my wealth charts platform, I don't want to focus on that too much because
Yeah.
I have nothing to sell. It's just education today. But you'll see on my tool called Wealth Finder, basically what it is, the whole premise of the tool is multi-time frame analysis and finding correlations
Yeah.
on different time frames. So you'll see all of these ones over here in orange are appearing on at least five time frames, the same signals. Okay.
Fantastic.
And so,
Fractal.
yeah. And so if we were to go look, for instance, you'll see here ASML, ASML,
Yeah.
ASML. Okay. You see that? Well, let's go here.
Monthly, weekly, and daily.
You got it. So now let's go ahead and go take a look at my website, becomeabettertrader.com, and just put my money where my mouth is here. If we go to free tools, go down here to the first video I shot of the year, January 5th. And so what I did was at that time here, I was kind of pump forward, I was showing how some of these strategies like the IRBs and reverse IRBs were firing off on different tools. Well, so what I did was, there it is. So I did a dissertation here, if you will. This was back on the 5th of January. And you'll see here, I was, if you go watch the video, I was pointing to ASML on the different time frames, which is why I was showing it. Okay. I'm trying to sneak back and see if I can just find the actual minute, but that's okay. I'll just keep going. You guys are welcome to go watch the videos.
Yeah.
The point is that what I was doing was NXPI was coming up on multiple time frames, as well as NTES was coming up. So I highlighted all those. Well, I'll let you guys, so you can see how I was kind of highlighting those over there. But the
and when you're looking at those signals, like what are those signals that are triggering on the weekly, monthly, daily?
Well,
what did ASML?
First of all, take a look right over here. What have I just been teaching you right now?
Yep, the accumulation distribution.
That's right. So here's an inventory retracement bar that just broke above the high there. You see it?
So when it says like on daily ASML 5+,
that means it's been on more than 5 or more bars consecutively signaling on this. So not only is the orange in Wealth Finder going ahead and saying, hey, on 5 or more time frames here, so at least monthly, weekly, daily. In fact, this is my video, so I have to go back to the actual where did my actual live? Here we go. It's like separating the video from the actual live. So here we go. So ASML, which we're just looking at, there's ASML, there's ASML, there's ASML. So there's 3. Let's go take a look. Oh, there you see it on the 240-minute chart and the 120-minute chart. So it's on at least 5 time frames that it's firing off there. That's what the orange means. Okay. So that's the fractal nature of what I like to do. Does that make sense? The cycle within the cycle.
Yes, absolutely.
Okay. Love it. And so going back over here to what we were saying then, I want to answer all those questions for you, Richard. I just don't want it to turn into like a, I'm not trying to advertise my, wealth charts, but
that's all right, Rob.
But I just,
you're here.
It's just you practice what we preach, right? It's like that's very important to me. Those algorithms inside of wealth charts are algorithms based on culmination of my life's work. So I just wanted to put my money where my mouth is, that the multi-time frame analysis, fractal nature of things, super important to me.
Well, I'm a systems scientist by training and studied fractals, chaos theory, catastrophe theory, all of those different mathematical patterns. So that's of great interest to me.
Yeah, great. So as we go ahead then and look, so what you can do, and then speaking of multi-time frame, there's also multi-signal. So what happened was you saw the signal where we had in a downtrend, a short-term overbought condition in that downtrend. the very first the bar preceding the bar that actually generated the IRB sell signal. Now this is a whole strategy. In fact, ironically, if you look at that same chart that I was just talking about, that's the same strategy that I use. So like I'm looking for an uptrend. All these little green dots and dark green dots are IRBs and reverse IRBs, the same things I'm talking to you about today. But then I also go ahead and combine in there with it these stochastic pullbacks. So within an uptrend, I want to see these short-term oversold conditions in the uptrend, and those become reentry opportunities. And so cycles within cycles is, I guess, the theme there.
And
Okay.
what stochastics do you use settings?
Well, so every platform has them a little bit differently. Some platforms calls it the fast stochastic. Some platforms call it the stochastic. And I've even seen some of the platforms call it the slow stochastic. Stochastic is about the worst possible thing that you can go ahead and, because if you look, stochastic, they call it different things in different platforms. I made it really easy for people inside of wealth charts because it's like we have fast and we have slow stochastics, we have all those. So I just made it really easy for people just to go in there, go under my name, and just see spike, so that you don't have to go figure out like what which ones is which. And so I'll skip some of these, but what these were is examples of you have the trend in some places where I was doing some live trading with this, where we had those bars that are off the highs. This is just examples of in the trend, the bars pulling back and then breaking out above these areas here. And I'm showing some different platforms because even though I own this wonderfully advanced charting platform, the methodology is broker platform agnostic. So what I want to do here, and you'll see, by the way, a lot of this was the cycles turning. I don't know if you guys saw that there, but a lot of these are the process of going from a sideways market or a downtrend, reverting back to a different direction. And that's why I was saying for you here today that if you study cycles, this is great, because then if you can find the cycle and then find the setup within it, then that's a great, best of all worlds. Now, another
Jake
thing.
Bernstein teaches setup, trigger, and follow through.
Great. And that's wonderful. And actually, Jake has got a lot of work inside of our platform. If you look here, indicators, premium, right over here, these are all like anybody who's a member, Richard, gets access to all these indicators of Jake's here.
Beautiful.
Yeah. So obviously we're big fans of Jake there. So as we go ahead and we take a look, I just wanted to say one more thing before I move on. In a sideways market condition, these areas can be key support and resistance levels until broken. And so that's a powerful thing that people should understand. I would love to talk. I would definitely need more hours to go and talk about all the different uses of these.
We'll have you back sometime.
And that's great. Love to come back when I'm not doing my other show too, and I can spend hours with you guys. So the key is here. I actually use this helped me win a big trading competition in Las Vegas one year. What had happened was I was trading live. The market had pulled back. I'd gone long, and then it pushed back up. And what happened was we were coming right back up into that big resistance area. And so I'd even announced to the audience, hey, you know what? And my competitor, I'm like, hey, you know what? I'm getting out of here. I'm taking my profits, walking away. He stayed in a trade that he was in, and the market turned around and tanked on him. I got out, locked in my profit, and won the trading competition. The key is that these are distribution. They are resistance until broken. Because one or more institutions has proven with their money, they're not only willing to stop the market from going up, but they're willing to drive it back down. So it is resistance until broken. Okay.
Got it.
So,
excellent.
And this was actually more rendition of that trade that I was talking about from Las Vegas there. So it's a big fat bar in the backdrop. You can see it pull back, it pushed back up again, pull back, try to push back up in there again, pull back, failed, try to come back a little while later, hit it one more time, died, and never looked back the rest of the day, never reached that high again. So it's a key resistance until broken. Okay. So the what I'll do here, I want to quickly, because I see our time is running low, I want to at least discuss the reverse inventory retracement bar, because this opens up several more additional opportunities. Here's the good news. The only part that's different between the inventory retracement bar is this. It's a very important difference, but it's basically the only difference as far as the two, but it's an important one that basically doubles the number of trading opportunities. So now looking back over the last 20 periods for signal bars where the open and the close are approximately 45% or more off their low in an uptrend, or 45% or more off their high in a downtrend. So the 45% is now exactly flipped on its head, the opposite side. All right. So the same kind of human emotion takes place. Remember, before we were in a downtrend and we wanted it to pull back up, spooking out the retail traders who were looking at shorting, and then come back down below and then break down. Well, now we're looking for exactly the opposite. Now I'm looking for the same bars effectively to open up, go down first, and immediately shake the tree, right? How many of you here have ever looked to get into a trade, whether it's a day trade, a swing trade? You were looking at this thing, you'd been watching the market going up, but it opened up and immediately went down, only to close back high at the end of the day. I don't know how many of you here have been trading since the late 90s, but that was basically the story of the year over and over again, 1998, 1999. What was happening was in the tech bubble, Richard, you may recall, you
That's
have
when
enough
I started trading.
Okay, so you'll remember every day it was like rinse, cycle, and repeat. The market would close the text would close at a new high. The next morning, the market would open up, it'd go down first, and then everybody would say, "That's it. It's the end of the world as we know it. The techs are finally going to blow up. PE ratios are crazy. This is this is all going to blow up."
Yeah.
And then by the end of the day, you'd be at new highs again. Then the next day, you'd open up. The market would open down, and it'd sell off violently for the first 15 minutes to half an hour, then it'd close up at the new high on the day. It was like clockwork. And so think of it in those terms. That in fact, you know what, where we can see the same thing as coronavirus here. Middle of last year.
Months. Yeah.
The last 9 months, same thing. It's like, oh my gosh, it's the end of the world as we know it. Everybody's going to be poor, broke, unemployment, et cetera, et cetera, et cetera. It can't last. And what did it do? Went up, pulled back each morning, sold off, went back up. Same concept. So you don't even have to be trading back in the dinosaur ages like me and Richard to go ahead and remember it. You had it last year. Same concept. So what I'm looking for is I'm kind of looking for it now to open up, pull down first, shake people of their will and their desire and their passion to want to go long, and then close back up. And so then what I'm looking to do at this point now, I'm looking to go long in the uptrend, 1 tick, 1 cent, 1 pip above the high. So it's a continuation pattern. In a downtrend, I'm looking for, there's that 45% or more off the high in the downtrend. And then I'm looking for it to go 1 tick, 1 cent, 1 pip below the low, and then go short back into the direction of the trend. So first it's opening, going up, making people think, ooh, I better not take that short, and then come right back down. So before we talked about these on that traditional Apple chart that I showed you earlier. Okay, so there's a handful there. Let's go take a look at it now with the additional ones. Look at that. Okay, right there, right before the big fall, you had the reverse inventory retracement bar. Right over here, you had the reverse inventory retracement bar, whoosh. Right before the big whoosh over here, you had the 2 reverse inventory retracement bars. Then you had another one. So in other words, you went from 1, 2, 3, 4, 5, 6, 7 to 8, 9, 10, 11, 12. See how it gives you several more opportunities? And so remember this chart with the Apple post split. 1, 2, 3, 4, 5 opportunities there that we showed you with the classic IRB strategy. With the reverse IRB strategy, now you went to 6, 7, 8, 9, 10, 11, 12, 13. So it basically nearly doubles on average the number of potential opportunities that you have to get into a trade. Put another way, these green dots versus the dark green dots. The green dots, so one of them is IRB, the other one of them is reverse IRB. So the dark green dots are the classic IRB. The bright green dots are the reverse IRB. Take a look. You've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 of the bright green. And then you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 more dark green. So look at that. Instead of 13 or 19 opportunities, you have roughly 32 opportunities. Does that make sense, Richard?
It does. I'm going to drill down into it a little bit. Maybe you could even zoom in just because. So we're in an uptrend.
Yep.
I was clear on the initial IRB concept. 45% of the
off the high
bottom is
off the high.
Oh, okay, off the high, right?
The classic
wicks, right?
IRB, classic IRB is off the high in the uptrend.
Right. Okay.
The reverse inventory retracement bar is 45% off the low in the uptrend.
Yep.
Off the low in the uptrend.
And so, that's where you really are seeing accumulation with the follow through.
That's right.
Trend. And the other one, you're seeing a little bit of distribution, but then that distribution gets reversed.
Exactly. But it's the same concept. It's only one or more institutions that's temporarily holding the market down on the distribution side, right? Yeah. But then, it could be any number of them that are accumulating every time it pulls back.
But the real key to all of this work is this idea, and to me, this is where it connects back to cycles, that you have these cycles of human emotion. These cycles, somehow these bars, that 45% threshold is representing kind of a psychological whipsaw of, the other market participants that you're then capitalizing on when it gets reversed.
That's correct. Yes. And so it's very much, and that's why I said I could go and spend a lot of time on this one particular slide, which let's see if I can bring it back over there just for a moment here, because this is really what it's all about. It's trying to get everybody here to think more like the hunter instead of the hunted.
Yeah, and talk about that a little bit more. What's the difference?
Well, the difference is being reactionary and afraid and getting spooked away from the trade versus being proactive and sitting there. So now when you're in the uptrend and you start to see the market pull back a little bit, no longer are you thinking, oh, good thing I didn't take that trade. That would have been another one of those losers. You're sitting there going in and saying, oh, look at this. Look what they're doing. They're pulling this back right now. All right, great. Now I'm going to be sitting here waiting for this to go right back up here above. I'll go ahead and I'll wait till my alert triggers off. So your mindset is completely no longer are you the victim. You're the hunter in this case.
This is an important slide. So
I could spend hours on it. Yeah.
Avoid buy-side mistakes where institutions distract buyers from wanting to buy. So they're kind of pulling the market back, making you think that you shouldn't buy, right?
They're giving sellers false hope. So if the market was in other words, if the market was going up and they shorted down here, and then so the market starts to pull back a little bit, then they're like, go back down, please, right? Yep. And then stopping out the late buyers. You need the big fast bars. So what ends up happening, because a lot of those bars that then come back well off their highs, the market's going up a little bit, going up a little bit, going up a little bit, going up a little bit. And they're like, oh, I should have gotten in. Then all of a sudden it goes boom, 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 boom. And you're like, oh my gosh, I should have gotten it there. I should have gotten it here. I can't take it anymore. Right. I get in up here, and then it turns right around and starts coming back down. And no sooner does it ever feel like, well, you even said it yourself, Richard, at one point.
I could move markets.
I could move the markets. No sooner did you get in than it reversed, right? So a lot of times those big bars are those blow-offs. So
that's a great analogy of hunter and hunted, because you can feel it. You can feel it when you're jumping around, when you're the prey, who's being led around by the bait. You are being hunted.
Yeah, and so I have, what I'll just do in closing there, because
Yeah.
I could spend a great deal of time there with you guys on this. What I'll do is, so what we talked about there was wealth charts,
Yep.
and that's what these alerts are on. But um, I don't want anybody to worry about that today. I just want to give away something absolutely free to people, Richard.
Appreciate it.
The IRB strategy guide here and the trade planning guide and strategy workbook and trader
Great.
preparedness checklist got a whole bunch of tools. You guys can just go to becomeabettertrader.com/tools and just get access to those tools for free there. Someday down the road, we can do another class, talk about wealth charts, whatever. But for today, I just want you guys to understand those are some tools that are near and dear to my heart. And hopefully, like I said, Richard will be inviting me back, and I can talk more about some of the other tools and strategies that we use as well. But Richard, I don't know if you want to pop the URL in there or something for people, becomeabettertrader.com/tools. But otherwise, I hope this was beneficial, Richard, and you can see why I use this as one of the many of my core strategies
Yeah.
to help me with the award-winning trading competition wins and beyond.
I thought it was fantastic, Rob. Really helpful. Not only did we get some great tools, but I think we got some great insights into how the markets really work, which obviously you got to have that if you're going to be as successful as you are. So thank you so much. It was wonderful. Definitely would love to have you back. And I'd love to ask you sometime about your promise to the heavens. Maybe
I
next
will
time.
be happy to have you guys back here, and thank you so very much. Be back here with you guys. You guys are wonderful, and thanks for being the world's greatest students and listeners. Thanks for being part of the Foundation for the Study of Cycles.
Yes. Thank you for the reminder, Rob. We are the Foundation for the Study of Cycles. We are a 501c3 not-for-profit, celebrating our 80th year. We want to continue to bring you all incredible content and education from luminaries like Rob Hoffman here. So please do support us. Become a member. It's just $99 a year. Better yet, become a member and make a donation. And thank you again, Rob, and thank you everybody for tuning in. Have a great night.
Absolutely. Have a great night.